come to our session of taxation, and in this particular session, we are going to look at the concept or discuss the concept of residence in Kenya for taxation purposes. The concept of residence in Kenya for taxation purposes. Now, this concept of residence is very important because in subsequent discussions of taxation, we keep on mentioning whether an individual or a taxpayer is resident in Kenya or non-resident in Kenya. And it has implications on what incomes are going to be taxed in Kenya and what incomes are not going to be taxed in Kenya, and overall, the tax liability of a person. Now, we put it in two forms, and the first criteria is in relation to an individual. So that will be the first criteria to consider. So in relation to an individual, a resident means that one who has a permanent home in Kenya, that one who has a permanent home in Kenya, or that person who has a permanent home in Kenya and was in Kenya for any period during the year of income under consideration, and was in Kenya for any period during the year of income under consideration. Then, number two, it is that person who has no permanent home in Kenya, but was in Kenya, for an aggregate of 183 days or more during the year of income under consideration. So the second criteria, we are looking at that person who has no permanent home in Kenya, but was in Kenya for an aggregate of 183 days or more during the year under consideration. The key thing here is the number of days, and therefore 183 days. Remember, the first category was for the person who has a permanent home in Kenya. Now we are looking at a person who has no permanent home in Kenya. Then B, for persons whose visits average to more than 122 days during the year of income. So for persons whose visits in Kenya averages to more than 122 days during the year of income under consideration and the two preceding years. So we are looking at a person who has no permanent home in Kenya but has kept on visiting Kenya. And these visitations are averaging to more than 122 days during the year under consideration and the two preceding years. So again, this person will be taken to be a resident if that condition is met. Therefore, in relation to an individual, resident is defined by either having a permanent home in Kenya. So if you have a permanent home in Kenya, that person is an ordinary resident of Kenya. That is ordinary residence in Kenya. Then we're also looking at persons who have no permanent homes in Kenya. And our concern for these people is the number of days they have been in Kenya during the year under consideration. And in the third case, the average of the number of days they have visited Kenya in the year under consideration and the two preceding years. Now, for this particular case, I can just take a simple case to illustrate how we take this average. So we'll take a person, for instance, who has been in Kenya as follows. A person who has been in Kenya as follows. So days in Kenya, so year, and then you can take days in Kenya. So we can take the year 2014. And we check that this person was in Kenya for 120 days. And perhaps in 2013, this person also visited Kenya and maybe was in Kenya for 115 days. And also, he could have been in Kenya in the other year, which is 2012. And perhaps he was in Kenya for 200 days. And maybe we can also take the year 2011, that this person visited Kenya, did not visit Kenya. So was not at all in Kenya. In this case, then, we can be asked to determine his resident status in 2014. So we are interested with the resident status in 2014. So residence status in 2014. So we would look at the conditions. Now, let's start by assuming that this person has no permanent home in Kenya. So resident status in 2014, assuming he has no permanent home in Kenya. So if this person has no permanent home in Kenya, we will test his resident status by looking at the number of days this person visited Kenya in the year in question. The year in question is 2014. So we said if a person does not have a permanent home in Kenya, we test with the first criteria, whether he was in Kenya for 183 days or more during the year under consideration. In this case, we see that this person was in Kenya in 2014 for only 120 days, and therefore you didn't meet the first criteria of 183 days or more. So we would go to the next criteria of testing, whether it meets the second condition. That is the average number of days he was in Kenya during the year under consideration and the 2 preceding years. So we would take the average days. So in this case, we are interested with the year under consideration, that is the year 2014 and the 2 preceding years. So that we take an average to see whether that average is 122, is more than 122. So we'll take the average to determine whether this person meets the average of more than 122 days. So we'll take the total of the year under consideration and the 2 preceding years. In this case, we have 120, we add 115 days, we add 200 days. That gives us 435 days. This 435 days is what we are saying we divide by 3. So this we divide by 3, and this gives us an average of 145 days. Now this 145 days is more than the average of more than 122 days. It's more than 122 days. If it is more than 122 days, then this person is considered a resident in the year under consideration. So we would therefore conclude and say, therefore, resident in 2014, since average is more than 122 days. It's more than 122 days. So that is as far as a person is concerned. So for an individual, we are looking at a permanent home, and we're also looking at the number of days this person has visited Kenya. The second criteria is in relation to a body corporate. So in relation to a body corporate, residence means what? It means, 1, that the body was incorporated under Kenyan laws. The body was incorporated under the Kenyan laws. Number 2, that the management and the control of the business was exercised in Kenya during the year of income under consideration. And number 3, that the body has been declared to be a resident by the Cabinet Secretary in charge of finance in the Kenya Gazette. I'll repeat the conditions of residence for a limited company, for a company, a body corporate in this case. That the body was incorporated under the Kenyan law, so incorporated in Kenya. 2, that the management and control of the business was exercised in Kenya during the year of income under consideration. 3, that the cooperative body has been declared resident by the Cabinet Secretary in charge of finance in the Kenya Gazette. So that will be the concept of residence in relation to body corporates. Again, very important to note or to know what the meaning of residence as far as the body corporate is concerned. Now, we will look at the implications or the tax implications or the significance of this concept of residence, this concept of residence. What are the differences? Now, the first thing to note, if it's a resident, for a resident, and in this case, a body corporate, if a body corporate is resident, the rate of corporate tax is 30% for a resident corporate body. If non-resident, the rate is 37.5%. So that is the rate now of taxation. So whether resident or non-resident, then we shall apply different rates for corporate tax. So resident 30%, non-resident corporate body 37.5%. Now, in the cases of individuals, for resident individuals, they are taxed at the graduated scale rates. They are taxed at the graduated scale rates, and they are granted personal relief. Personal relief is granted. That is 13,944 per annum for residents. For non-residents, they are also taxed at the graduated scale rates, and no personal relief is granted. So that is very important to note, that non-resident, that resident individuals are granted personal relief. Non-resident individuals are not granted personal relief. Again, the implication on the tax effect. Then, still on individuals, resident individuals, employment income is taxed in Kenya. Or employment income, total employment income from the world, from wherever earned, is taxable in Kenya. This is irrespective of where it is earned. So for a resident person, total employment income, irrespective of where it is earned, is taxed in Kenya. For an unresident, only the employment income derived in Kenya is taxed in Kenya. Only the employment income derived in Kenya is taxed in Kenya. The rest of the income is not taxed, is ignored. Then, still under a resident individual, business profits, that is the total, the total business profits is taxable in Kenya, irrespective of where the business is operated. Irrespective of where the business is operated, the total business income is taxable in Kenya. So if a resident person is operating a business partly in Kenya and partly outside Kenya, the total business income is taxable in Kenya. For an unresident person, only the business income derived from Kenya is taxable in Kenya, or only the business income earned in Kenya is taxed in Kenya. The rest of the income is ignored. The rest of the income is ignored. Then, for resident persons, rent, royalties, pension are all taxed at the normal graduated scale rates. That is other incomes for a resident individual, such as the rent, the royalties, the patents are taxed at the normal graduated scale rates. But for an unresident person, the rent, the patent, and the royalties and pension incomes are taxed at withholding tax rates. They are taxed at withholding tax rates, which are final taxes. So those are some of the significance or the implications of the concept of residence on the taxation of corporate bodies and the taxation of the individuals. It has effects on the rates to be used for purposes of taxation. It has also the effects on the amounts of income to be taxed in Kenya and the amounts of incomes not to be taxed in Kenya. So the concept of residence is very, very important for one to be able to know the income tax, the liabilities that is to be paid in Kenya. Now, After knowing that concept of residence, the next item that I would want to make clear is the criteria of taxing an income in Kenya. How is an income taxed in Kenya? Remember, we have said various incomes, depending on whether you are a resident or non-resident, will be taxed in Kenya. So it would be very important to know the criteria of taxing an income in Kenya. So, criteria. The criteria of taxing an income in Kenya. We have three things to consider. The first one is the income must accrue in Kenya, or the income must have been earned in Kenya for it to be taxed in Kenya. For it to have been taxed in Kenya. Then number two is that if it is the income is from services, then the services must have been rendered in Kenya. The services must have been rendered in Kenya. The third thing is that the payment for the services must have originated in Kenya. So for us to know whether an income is going to be taxed in Kenya or not, which is in this case the criteria of taxing an income in Kenya, we have to look at the income must accrue in Kenya, must have been earned in Kenya. If it is from the services must have been rendered in Kenya. And three, the payment for the services must have or must originate in Kenya. However, there are some exemptions to this rule. The three rules we have put above. Now, which are these exemptions? One,